Welcome back to Yield Report Daily. Today we are tackling a question that comes up constantly for people who are just getting started with investing. What is the difference between an ETF and an index fund? And more importantly, does it matter which one you choose? The short answer is that the difference is smaller than most people think, and for the majority of everyday investors, the choice between them is unlikely to have a significant impact on long-term outcomes. But there are real differences worth understanding, and knowing them will help you make a more informed decision when you are setting up your investment accounts. Let us start with the basics. An index fund is a type of investment fund designed to track the performance of a specific market index. An index is just a list of stocks or other securities selected according to defined rules. The most commonly discussed example in the United States is the S&P 500, which is a list of 500 large publicly traded American companies. An index fund that tracks the S&P 500 aims to own those 500 companies in the same proportions as the index, so your investment rises and falls with the collective performance of those companies. An ETF, which stands for Exchange Traded Fund, is also a type of investment fund that typically tracks an index. So in that sense, most ETFs are index funds. The key structural difference is in how each is traded. A traditional index fund, often called a mutual fund, is priced once per day after the market closes. You place an order and it executes at the end of day price, known as the net asset value. An ETF, on the other hand, trades throughout the day on a stock exchange just like an individual stock does. You can buy or sell an ETF at any time during market hours at the current market price. That trading flexibility is the most commonly cited structural difference. But here is the important question. Does being able to trade throughout the day actually matter for a long-term investor? For most people building wealth over decades, the answer is no. If you are investing a fixed amount each month and holding for 30 years, whether you buy at 9:30 in the morning or 4 in the afternoon is irrelevant to your long-term outcome. The intraday trading feature of ETFs is genuinely useful for active traders, but for buy-and-hold long-term investors, it rarely makes a practical difference. Now let us talk about cost, because this is where things get a bit more nuanced. The cost of a fund is typically expressed as an expense ratio, which is an annual percentage fee that covers the fund's operating costs. For both ETFs and traditional index mutual funds, expense ratios have fallen dramatically over the past 2 decades, and the very cheapest options in both categories now charge almost nothing. For example, some of the most widely discussed broad market ETFs from major providers charge expense ratios as low as 0.03% per year. Some traditional index mutual funds are equally cheap, and a small number are even available with zero expense ratios. In practice, the cost difference between a cheap ETF and a cheap index mutual fund tracking the same index is often negligible. What matters most is not whether you choose an ETF or a mutual fund, but whether you are choosing a low-cost option in either category. There are a couple of other practical differences worth knowing. First, minimum investment amounts. Many traditional index mutual funds have minimum initial investment requirements, which might be $1,000 or $3,000 or sometimes more. ETFs, because they trade like stocks, can typically be purchased in any amount above the price of a single share, and many brokers now offer fractional shares, so you can invest any dollar amount you choose. This makes ETFs more accessible for beginners who are starting with smaller amounts. Second, the question of automatic investing. Traditional index mutual funds have long made it easy to set up automatic recurring investments, where a fixed dollar amount is invested on a regular schedule without any manual action. ETFs have historically been slightly more cumbersome to automate in this way, though many brokers have now added tools that allow automatic ETF purchases as well. If automation is important to your strategy, it is worth checking how your specific brokerage handles this for the fund type you are considering. Third, tax efficiency. ETFs have a structural advantage in taxable brokerage accounts that makes them slightly more tax efficient than traditional mutual funds in many cases. This has to do with the way each fund type handles investor redemptions internally, and it is a somewhat technical point. In tax-advantaged accounts like a Roth IRA or a 401k, this difference is irrelevant, because the account itself shields you from the relevant taxes. For investors using a taxable brokerage account, ETFs are generally considered the more tax-efficient choice, though the magnitude of this advantage depends on the specific fund and your circumstances. So to bring it all together, ETFs and index funds are more similar than they are different. Both can give you broad diversification at low cost. The main practical distinctions are that ETFs trade throughout the day while mutual funds price once daily, that ETFs tend to have lower or no minimums, and that ETFs offer a tax efficiency advantage in taxable accounts. For most beginners, the most important decision is not ETF versus index fund, but rather choosing a low-cost option that tracks a broad market index and sticking with it consistently over time. If you want to go deeper on the investing vehicles themselves, we have dedicated videos on index funds and dollar cost averaging on this channel that are worth watching next. Links are in the description below. And as always, nothing on this channel is financial advice. We are here to break things down in plain language so you can make informed decisions for your own situation. If this video was helpful, please hit the like button and subscribe. We publish new personal finance videos twice a week, and there is plenty more to come. We will see you in the next one.